Using financial ratios. A firm's financial statements can be very helpful in understanding their overall condition. For example, investors may look at the income statement to see if the company is making a profit. From the balance sheet, lenders can tell how much debt the company has and when it is due. The statement of cash flows is very helpful in understanding how well the company manages its cash. Financial ratios help managers, investors, and creditors evaluate a company's financial condition. Several common ratios are the current ratio, the debt ratio, earnings per share, and total asset turnover. The current ratio measures the ability of the firm to generate cash and pay liabilities as they come due. The formula for the current ratio is current assets divided by current liabilities. A general rule is that the current ratio should be at least 2, which means that the firm has twice as many current assets as current liabilities. However, it is more accurate to compare the current ratio to other companies in the same industry. Using the data from Google's balance sheet, we see that the firm has current assets of $60,454 million and current liabilities of $14,337 million. Google has a very strong current ratio at 4.2, well above the industry average of 1.4. The debt ratio measures the extent to which the organization has used debt rather than equity to purchase assets. The formula for the debt ratio is total liabilities divided by total assets. Unlike equity, debt must be repaid, so a firm with a high debt ratio runs the risk of being unable to pay its liabilities as they come due. Looking again at Google's balance sheet, we see that Google has total liabilities of $22,083 million and total assets of $93,798 million. Google's debt ratio of 23.5% indicates that they have primarily funded their operations with equity and are very likely to be able to repay their debt as it comes due. Investors often use earnings per share to evaluate the attractiveness of common stock as an investment. Earnings per share is calculated by dividing net income by the number of common shares outstanding. Generally, an increase in earnings per share is associated with an increase in the market price of the stock. From Google's income statement, we see that they had 2012 earnings of $10,737 million and had 332,300,000 shares of common stock outstanding. As a result, earnings per share for Google's stock was $32.31 per share. There are many different activity ratios that evaluate the efficiency of management. One of these activity ratios is total asset turnover. Total asset turnover is calculated as sales divided by total assets. It shows how much revenue is generated for each dollar invested in assets. Google's 2012 sales were $50,175 million. When we divide this by total assets of $93,978 million, we arrive at a total asset turnover ratio of 53 cents of sales for each dollar invested in assets. Google's 2011 total asset turnover ratio was 0.52, indicating a positive trend and suggesting efficient management. As you can see, financial ratio analysis can assist investors, creditors, and managers as they evaluate a firm's financial statements. Ratio analysis can reveal the ability of the firm to repay debt as well as how efficiently the company is being managed.